Imagine the world of trade, a complex web of ships, goods, and money, suddenly caught in a massive storm. That's not far from what unfolded in early 2025 as sweeping U.S. tariff increases began to dramatically reshape global commerce. These weren't just minor tweaks, these were game-changing policies. The United States announced new reciprocal tariffs affecting most of its trade partners. The idea was to base these tariffs on trade deficit ratios, with a minimum hike of 10 percentage points. This catapulted the effective tariff rate on U.S. imports to nearly 30%, a massive leap from the pre-administration level of just 3%. And in a full implementation scenario, that rate could soar to almost 38%. The tit-for-tat escalation with China alone played a huge role in this surge. So what happens when you throw such a large rock into the global economic pond? The ripples are extensive. Various analyses are painting a concerning picture for U.S. real GDP growth. JP Morgan Research, for example, revised its 2025 U.S. real GDP growth forecast downward by 0.3%, settling at 1.6%, primarily due to this trade policy uncertainty and existing tariffs. Other estimates suggest U.S. GDP could shrink by 0.5% to 1%, just from the April 2nd tariff announcement. And when you factor in all the 2025 tariffs and potential retaliation from other countries, that figure could be 0.8 to 0.9%, with one model even suggesting a 6% hit in the long run. Global GDP isn't escaping unscathed either. It's also expected to decline. For consumers, these tariffs generally mean one thing: higher prices. Estimates point to a significant boost to headline inflation. Personal consumption expenditures prices, a key inflation measure, could rise by 1 to 1.5% in 2025. What does that mean for your wallet? It could translate to an average increased cost of $1,200 to $4,000 per U.S. household in 2025. Certain goods, like apparel, could see price jumps as high as 17%. The very flow of goods is being rerouted. Direct trade between the U.S. and China is predicted to collapse by a staggering 90%, as nearly all Chinese goods face tariffs so high they're almost prohibitive. While some Chinese products might find their way to the U.S. indirectly, overall U.S. imports are set to fall substantially. This is triggering a major reconfiguration of global value chains, potentially leading to a less efficient and more opaque trade system. Chinese exports are expected to divert to other markets, like the Euro area and the UK, and US ports have already reported a drop in container shipments. Beyond the direct financial costs, there are significant welfare losses anticipated. This is an economic term for a reduction in overall societal well-being. The US could see welfare losses around 2%, and nearly double that if full retaliation occurs. China's welfare losses are estimated at around 1.5%, while the Euro area's impact is expected to be more contained. Globally, these losses could reach up to 2%. This heightened trade policy uncertainty is understandably making businesses nervous. Business and household sentiment are taking a hit, which can amplify the direct economic impact of tariffs. This uncertainty is expected to weigh heavily on capital spending, with many companies hesitant to even predict their future earnings. And what about jobs? Some estimates suggest a loss of hundreds of thousands of full-time equivalent jobs in the U.S. Now, there's an argument that tariffs generate federal revenue. Projections range from $1.5 trillion to $5.2 trillion over the next decade. However, these gains would likely be partially offset by the negative dynamic effects on the economy, things like slower growth and, consequently, reduced tax revenue from households and companies. Retaliation from other countries would cut into those net revenue gains even further. Let's zoom in on specific sectors. Steel and aluminum imports have been hit with 25% tariffs, which could drive up prices for everyday items like automobiles and canned drinks. Speaking of automobiles, they also face 25% tariffs on certain auto parts. The situation with China is particularly intense. As the U.S. progressively increased tariffs on Chinese imports, reaching an astonishing 125% by early April 2025, China responded in kind, matching that 125% tariff on U.S. goods. However, there were some signals in late April that the U.S. might reduce these high rates depending on negotiations. Even U.S. neighbors Canada and Mexico face new 25% tariffs linked to concerns over fentanyl and migration, though some exemptions exist. The book industry is feeling the pressure from rising costs for paper and printing, especially from China, and U.S. publishers exporting books might face retaliatory tariffs. And small businesses? Many are struggling with these hefty new fees, with some facing existential threats because they simply can't absorb the costs. So how is the world reacting? Major trading partners, including China and the European Union, have announced or imposed their own retaliatory tariffs on U.S. exports. Countries are actively exploring trade diversification. Canada, for instance, is looking into trade options beyond the U.S. capital, has reportedly been moving from U.S. markets to Europe, and there's an increase in nearshoring as companies scramble to adjust their supply chains. Amidst all this, there's a threat of negotiation and uncertainty. The U.S. administration has indicated that tariffs could be modified. A 90-day pause on reciprocal tariffs, though not the 10% base, was announced for most countries to allow for trade talks. And as mentioned, there are signals of potential easing on China tariffs, contingent on a deal. This inflationary pressure from tariffs also complicates decisions for central banks. It could slow the pace of interest rate cuts, even if the inflation proves temporary. The European Central Bank has cut rates, while the U.S. Federal Reserve is navigating these rising price pressures. The driving force behind this U.S. tariff strategy is an America-first trade policy. The aims are to strengthen domestic industries, reduce reliance on foreign manufacturing, and address what are perceived as national security threats, including those related to trade deficits and specific industries like copper, semiconductors, and pharmaceuticals. The timeline of these changes in early 2025 was incredibly rapid. On February 1st, tariffs hit imports from Canada, Mexico, and China related to migration and fentanyl. February 11th saw reinstated and increased tariffs on aluminum and steel. March 12th brought expanded tariffs on steel, aluminum, and their derivatives. March 26th was the announcement of 25% tariffs on automobiles. Then, April 2nd, the big one. The announcement of sweeping reciprocal tariffs based on trade deficits, with the president declaring a national emergency. By April 5th, a baseline 10% tariff was effective for all countries. On April 9th, higher individualized tariffs hit 57 specific countries, and the U.S. further raised tariffs on China to 125%, though it also announced that 90-day pause for many others. China quickly matched, raising its tariffs on U.S. goods to 125% by April 11th. By late April came those hints of potential easing with China. In essence, the U.S. tariff policies enacted in early 2025 have injected significant uncertainty and disruption into global trade, with substantial economic consequences rippling across the U.S. and its trading partners. The situation remains incredibly fluid, with ongoing policy adjustments, retaliatory measures, and potential negotiations constantly shaping the future landscape of international commerce. It's a complex and rapidly evolving story, and you can count on Fun Facts Online to keep tracking the twists and turns.